Before we dive in, please remember that I am not a financial advisor, and this presentation is for informational and educational purposes only. The world of real estate and lending is complex and changes constantly. All examples are hypothetical. Always consult with a qualified professional, like a licensed mortgage loan originator or a certified financial planner, before making any financial decisions. Picture this: you've been scrolling Zillow for months, maybe even years. You've seen the insane prices, the $500,000 starter homes, the bidding wars. Feels hopeless. But then you find it. The unicorn. A small, charming house, maybe in a quiet town just outside the city, or a cozy condo in a building you never noticed before. It needs a little love, sure, but it's got good bones. And the price tag? $60,000. $60,000. In today's market, that's not just a deal, it's a miracle. Your mind starts racing. The mortgage payment would be less than your rent. You could finally own something, build equity, paint the walls whatever color you want. You've got a good job, a solid credit score, and a down payment saved up. This is it. This is your shot. So you walk into a big familiar bank, the one you see on every corner. Feeling confident, maybe even a little triumphant. You sit down with a loan officer, lay out your plan, and ask for a $60,000 mortgage. And the loan officer gives you a polite, sympathetic smile and says, "I'm so sorry, but we can't help you with that." Your heart sinks. You ask why. They mumble something about minimum loan amounts, and it's just our policy. You leave the bank feeling confused, frustrated, and completely defeated. It makes no sense. They'll gladly lend someone $500,000 to buy an overpriced house, but they won't lend you a tiny fraction of that for an affordable one? This isn't a made-up story. This exact scenario plays out every single day in bank branches all across America, and it leaves people asking the same question. Can you even get a $60,000 mortgage in the USA? The short answer is yes, you absolutely can. But the reason it feels impossible is that you're playing a game where the rules are stacked against you. The big banks, the ones with the flashy commercials and the massive skyscrapers, have built a system that is designed to ignore you. But today we're going to change that. In this video, I'm going to pull back the curtain and show you exactly why getting a small mortgage is so difficult. We're going to dissect the hidden economics that make banks turn you away. But more importantly, I'm going to give you a step-by-step playbook on how to navigate this broken system. We'll cover the specific types of lenders you need to be talking to, the ones who actually want your business. We'll explore alternative financing strategies you've probably never heard of. And by the end of this video, you will have a clear, actionable plan to get that small mortgage and buy that affordable home. You will know more than 99% of aspiring homebuyers about this niche, and you'll be equipped to beat the banks at their own game. So let's start with the fundamental question. Why would a bank that's in the business of lending money refuse to lend you a small amount of money? Feels completely backward. You're a lower risk. If you default, their potential loss is tiny compared to a massive mortgage. So what's the deal? The answer, in one word, is profit. But not in the way you think. It's not that the bank can't make money on a $60,000 loan. They can. The problem is they can't make enough money to justify the effort. It's a concept we can call the profit paradox of small mortgages. To understand this, you need to understand how a bank actually makes money on a home loan. They have two primary ways: upfront fees and long-term interest. First, let's talk about the work involved. The amount of work it takes for a bank to process a $60,000 mortgage is almost identical to the amount of work it takes to process a $600,000 mortgage. Think about it. For either loan, the bank has to pay a loan officer to work with you. They have to pay a loan processor to gather all your documents, your pay stubs, your tax returns, your bank statements. They have to pay an underwriter to meticulously review that file, check your credit history, analyze your debt-to-income ratio, and make sure you meet all the lending guidelines set by Fannie Mae or Freddie Mac. They have to order an appraisal to confirm the house is worth the price. They have to run title searches to make sure the property is free of liens. All of these steps involve real people with real salaries spending real time on your application. Let's be conservative and say the bank's fixed internal cost to do all of this work, the paperwork, the salaries, the compliance checks, is about $3,000 per loan. This is their cost of doing business, whether the loan is for $60,000 or $600,000. It's a flat fee, an operational expense. Now let's look at the income side. The bank's main upfront profit comes from something called an origination fee. This is typically a percentage of the loan amount, often around 1%. So on a $600,000 mortgage, A 1% origination fee is $6,000. The bank pays its $3,000 in fixed costs, and it walks away with a nice clean $3,000 profit right at the closing table. That's a good deal for them. But what about your $60,000 loan? A 1% origination fee on your loan is a measly $600. The bank still has to spend that same $3,000 on the underwriting and processing. So, on your loan, they're not making a profit. They are instantly losing $2,400 just for the privilege of giving you a mortgage. No business on earth is going to willingly sign up for a deal where they lose money on day one. Simply bad business. This is the single biggest reason you get that polite no at the big bank. Your loan doesn't just generate a small profit. It generates a guaranteed loss on their books from the moment you sign the papers. Of course, you might be thinking, but what about the interest? They'll make money on me for the next 30 years. And you're right, they do. But we have to look at that from their perspective too. Let's say the interest rate on both loans is 7%. On the $600,000 loan, the borrower pays about $35,000 in interest in the very first year alone. That's a massive steady stream of income for the bank. On your $60,000 loan, you'll pay about $3,500 in interest in the first year. From the bank's point of view, they have a choice. They can dedicate one of their underwriters for a week to process the big loan, lose no money up front, and get a $35,000 income stream. Or they can have that same underwriter spend the same week processing your small loan, lose over $2,000 up front, and get a $3,500 income stream. Which one would you choose if you were running the bank? It's a no-brainer. They will always prioritize the bigger, more profitable loan. They have a limited number of employees and a limited number of hours in the day. They are financially incentivized to chase the big fish and throw the small ones back. This isn't personal. The loan officer probably isn't a bad person. They're just an employee in a massive corporate machine that has been optimized for one thing: maximizing profit on a per-transaction basis. And small mortgages completely break their model. They are a square peg for a system of round holes. So when we talk about a $60,000 mortgage, we're really talking about a whole category of what the industry calls small balance loans. The exact threshold for what's considered small changes depending on where you live. In a very expensive market like San Francisco or New York City, a lender might consider anything under $200,000 to be a small loan. In a more affordable, rural part of the Midwest, that number might be closer to $75,000. But the underlying principle is exactly the same. If the loan amount is too small to cover the bank's fixed origination costs and generate a significant profit, you're going to have a hard time. So the first, most critical step in this journey is accepting this reality. Walking into a Bank of America or a Chase or a Wells Fargo to ask for a $60,000 loan is like walking into a Lamborghini dealership and asking for a Toyota Corolla. They just don't sell that product. It's not what they do. It's not where they make their money. Continuing to knock on those doors will only lead to more frustration. So if the giants of the industry won't help, who will? Where do you turn when the system seems designed to shut you out? This is where the game changes. Because there is an entire universe of lenders out there who operate on a completely different business model. Lenders who are smaller, more agile, and are specifically structured to serve communities and individuals that the big banks ignore. These are the lenders who see the value in your $60,000 loan. Finding them is the key. And the first place we need to look is right in your own backyard. We're talking about local banks and, even more importantly, credit unions. But approaching them requires a totally different strategy. You can't just walk in and apply. You have to understand their unique mission and how your small loan actually helps them achieve it. And that's exactly what we're going to break down next. Let's start with the most important mindset shift you need to make. When you walk into a giant national bank asking for a $60,000 mortgage, you are a rounding error. You are a tiny, insignificant transaction in a sea of multi-million-dollar commercial loans and $500,000 mortgages. Their entire system, from the software they use to the commissions their loan officers earn, is designed to process big, cookie-cutter loans as efficiently as possible. Your small, unique request is a wrench in their assembly line. It's not profitable, it's not efficient, and frankly, it's a nuisance. But when you walk into a local community bank or a credit union, the entire dynamic flips. You are no longer a rounding error. You are a potential long-term member of their community. You are a neighbor. Your $60,000 loan isn't a nuisance. It's an investment in the local housing market, an investment in a local family, an investment in the very community they were created to serve. You go from being a tiny fish in a vast, indifferent ocean to being a very important fish in a small, welcoming pond. And that change in perspective is everything. So, what exactly are these magical places? Let's start with credit unions. The key difference is right there in the ownership structure. A big bank is a for-profit corporation. Its primary legal duty is to make as much money as possible for its shareholders. A credit union, on the other hand, is a not-for-profit financial cooperative. Who owns it? You do. The members. The people who bank there. Think about what that means. There are no outside shareholders demanding ever-increasing profits. Any profit the credit union makes is returned to the members in the form of lower fees, better interest rates on savings accounts, and, most importantly for us, more flexible lending criteria. Their mission isn't to squeeze every last dollar out of you for a shareholder in New York. Their mission is to provide affordable financial services to their members. You getting a home, even with a small loan, is a direct fulfillment of their mission. It's a win for them. Community banks operate on a similar principle, though they are typically for profit. Their defining characteristic is their focus on a specific geographic area. They take deposits from the local community and they lend that money back out into the same community. The president of the bank might live down the street from you. They sponsor the local Little League team. Their success is fundamentally tied to the success of the local economy. A vacant, foreclosed home in their service area is bad for business. You buying that home with a $60,000 mortgage, stabilizing the property and paying local taxes, is good for their business. They have a vested interest in saying yes. Let's make this real. Imagine a woman named Sarah. Sarah is a 28-year-old graphic designer with a good, stable income, a 740 credit score, and a decent down payment saved up. She's not trying to buy a mansion. She found a small one-bedroom condo in a well-maintained older building. It's perfect for her. The price? $80,000. She has $20,000 for a down payment, so she needs a mortgage for $60,000. First, Sarah does what most people do. She goes online to one of the big national banks, let's call it Megacorp Bank. She fills out the pristine, user-friendly online application. The system's algorithm immediately sees the loan amount, $60,000. Red flag. It's below their unofficial, but very real minimum of $100,000. She gets an automated email a day later. Thank you for your interest, but we are unable to approve your application at this time. No explanation. No person to talk to. Just a digital dead end. Frustrated, Sarah makes an appointment at a physical Megacorp Bank branch. She sits down with the loan officer. He's a nice guy, but his hands are tied. He pulls up her file and sees the loan amount. He sighs. Look, he says. Honestly, the costs for us to originate, underwrite, and service a $60,000 loan are basically the same as a $600,000 loan. The profit margin just isn't there. The system won't even let me push it through. He then tries to upsell her on a personal loan with a much higher interest rate or suggests she borrow more money to do a renovation project. He's not trying to help Sarah. He's trying to fit her into a product box that makes money for Megacorp Bank. Sarah leaves, feeling defeated. This is the experience that makes people give up. They assume if the biggest bank in the country says no, everyone will. But Sarah remembers hearing something about a local credit union. So she decides to give it one last shot. She walks into the Main Street Credit Union. It's smaller. There's no fancy marble lobby. She sits down with a loan officer named Brenda. Brenda doesn't just ask for her social security number and income. She asks about the condo. She knows the building. Oh, the old Millview building? My cousin lives there. They have a great little community. Brenda looks at Sarah's finances. She sees the stable income, the great credit, the solid down payment. She sees a responsible young person trying to put down roots in the community. The $60,000 loan amount doesn't scare her. In fact, it's exactly the kind of loan they love to make. It's low risk and it helps a local member achieve a major life goal. But here is the crucial behind-the-scenes difference. This is the secret you need to understand. Brenda at the credit union has a superpower that the guy at Megacorp Bank doesn't: the portfolio loan. This is the single most important term you will learn in this entire video. A portfolio loan. Megacorp Bank and almost all large lenders don't actually keep your mortgage. The moment you sign the papers, they bundle it up with thousands of other mortgages and sell it on the secondary market to giant government-sponsored entities like Fannie Mae or Freddie Mac. This gets the loan off their books and gives them cash to make more loans. It's an assembly line. But to be sold to Fannie Mae or Freddie Mac, A loan has to fit into a very rigid box of rules. These are called conforming loan guidelines. And you guessed it, one of those unwritten but powerful guidelines is a minimum loan amount. A $60,000 loan doesn't fit in the box. It's non-conforming, so Megacorp Bank won't even touch it. Brenda at Main Street Credit Union is different. They are a portfolio lender. This means they intend to keep Sarah's loan in-house, on their own portfolio of investments, for the entire life of the loan. They are not selling it to anyone, and because they are not selling it, they do not have to follow Fannie Mae and Freddie Mac's rigid rules. They can set their own rules. They can use common sense. They can look at Sarah as a whole person, not just a set of data points on a form. They can say, does this loan make sense for Sarah? Yes. Does this loan make sense for us, the credit union? Yes. Is it a good investment in our community? Absolutely. Because they are keeping the loan themselves, they can be flexible. Maybe Sarah's condo is in a building that doesn't quite meet the strict criteria for a conforming loan. No problem. Maybe her income is from freelance work that the big bank's automated system doesn't understand. Brenda can look at her records and see the stable history. The portfolio loan gives them the freedom to lend when it makes sense, not just when an algorithm in another state says it's okay. 2 weeks later, Sarah gets a call from Brenda. Her $60,000 mortgage is approved. She's going to be a homeowner. The difference wasn't her credit, her income, or her down payment. The difference was walking through the right door and talking to the right kind of lender. Now, finding these portfolio lenders, these community banks and credit unions, is the first step. But just walking in isn't enough. You have to know how to present yourself and your loan request in a way that aligns with their mission. You need to speak their language. You have to show them, from the very first conversation, that you are the exact type of member they built their institution to serve. Doing this wrong can still lead to a quick no. Doing it right makes you their ideal candidate. And that's the playbook we're opening up in the next part. So let's crack open that playbook. The first page, the first rule, is a massive mindset shift. You are not walking into a bank, hat in hand, begging for scraps. You are a business professional, presenting a low-risk, profitable investment opportunity to a potential partner. Let that sink in. A $60,000 mortgage on a $90,000 house, for a borrower with a stable job and good credit, is one of the safest investments a community bank can possibly make. Your job is to make that fact blindingly, undeniably obvious. You're not the risky one here. The multi-million-dollar loan for a new and proven restaurant? That's a risk. A small, secured loan to a responsible member of the community? That's their bread and butter. That's the business model. You just have to walk in looking and sounding like the perfect case study for their annual report. This transformation from hopeful applicant to ideal candidate begins long before you ever speak to a soul. Starts with building your case file. The first step is to know your numbers colder than a January morning in Minnesota. I don't mean I think my credit score is pretty good. I mean, my FICO 8 score, pulled on Tuesday from Experian, is a 762. I don't mean I make decent money. I mean, my verifiable gross monthly income is $4,821, and my total monthly debt obligations, including my car payment and student loan, are $650, giving me a front-end debt-to-income ratio of 13.5% before the mortgage. See the difference? One is a vague hope. The other is an undeniable fact. The loan officer deals with vague hopes all day. They are starved for facts. You need to calculate your debt-to-income ratio, or DTI, yourself. It's simple. Add up all your monthly debt payments, car loan, student loans, credit card minimums, and divide it by your gross monthly income. Lenders get nervous when that number, including the potential new mortgage payment, gets over 43%. For a small loan, you want to be way under that. If you can walk in with a DTI under 30%, you become a golden goose. You're proving with math, their native language, that you are not a risk. Next, you need to craft your story. And I don't mean a sob story. I mean a stability story. Why this house? Why this town? Why now? Big banks don't care. To them, you're a number on a spreadsheet. But to a loan officer at a local credit union, the story is everything. It's the context that makes the numbers make sense. Your story should be concise, compelling, and rooted in the community. It's not, I'm tired of renting. It's, I've been a third-grade teacher at Lincoln Elementary for the past 6 years. I've saved up a 25% down payment, and I want to buy the house on Elm Street, which is a 4-minute walk from my school. My parents live 2 towns over. I volunteer at the local animal shelter. and I see this as the home I will live in for the next 30 years. I am not a flipper. I am putting down roots. That story tells them everything they need to know. Says stability. Says community commitment. It says you are highly unlikely to default and leave them with a vacant property, because your entire life is woven into the fabric of that town. You must write this story down. A single paragraph. Memorize it. It's your anchor. The third piece of your pregame prep is the property dossier. You cannot approach a lender about a $60,000 loan with a vague idea of buying a small house someday. You are wasting their time. Time is the one thing a loan officer doesn't have. You need to have a specific property identified. Print out the listing. Use Google Maps to calculate the property taxes for the last few years. Call a local insurance agent and get a quote for homeowners insurance. Add the estimated monthly principal and interest, taxes, and insurance together. This is your pity. You need to know this number. Your dossier shows you've done the homework. It proves you are a serious, organized buyer, not a dreamer. It takes you from the maybe pile and puts you at the top of the let's get this done pile. So now you have your numbers, your story, and your property dossier. You're ready to make contact. And you are not going to walk in unannounced. You're going to call the main line of the bank or credit union and use a very specific script. You'll say, "Good morning. I'm looking to speak with a residential mortgage loan officer." When they connect you, you'll say, "Hi, my name is..." Your name. "I'm a resident here in town name. And I'm in the process of purchasing a home. I've already identified the property and have my financial documentation prepared. I'm seeking a smaller mortgage in the $60,000 range, and I was told that bank name is deeply committed to supporting local homeownership. I was hoping I could schedule just 15 minutes of your time to present my file and see if I'm the type of candidate you partner with." Let's break down why that script is pure magic. First, you sound like a professional. Second, you state you've already done the work. Documentation prepared. This is music to their ears. Third, you state the loan amount clearly so you're not wasting time if they have a hard minimum of, say, $100,000. Fourth, you complimented them. Committed to supporting local homeownership, which shows you chose them for a reason. And fifth, you respected their time. Just 15 minutes. You have just positioned yourself as the most organized, serious, and professional applicant they will speak to all week. When you get that meeting, you're going to walk in with what I call the deal binder. Get a simple 1-inch 3-ring binder. On the cover, print a nice photo of the property with the address underneath. This is a psychological weapon. It makes the entire thing tangible and real from the second you sit down. Inside, you'll have 5 tabs. Tab 1 is the executive summary. This is your 1-paragraph stability story at the top, and a bulleted list of the key facts below it. Loan amount requested, $60,000. Property value, $90,000. Down payment, $30,000, 33%. Credit score, 762. Debt-to-income ratio, post-mortgage 28%. This one page tells them everything they need to know to say yes. The rest of the binder is just proof. Tab 2 is financials. This has your last 2 pay stubs, last 2 years of tax returns, and last 2 bank statements. Clean, organized, and ready. Tab 3 is credit. This has the full credit report that you pulled yourself. You're showing them you have nothing to hide and that you know your own file. Tab 4 is the property dossier. The listing sheet, the tax information, the insurance quote. Everything you prepared. Tab 5 is questions. You have 3 or 4 intelligent questions for them. What are your typical closing costs for a loan of this size? Do you service your loans in-house or sell them on the secondary market? This demonstrates that you are interviewing them as much as they are interviewing you. It rebalances the power dynamic. You will sit down, open the binder, and turn it around so they can see it. You won't ask, "Can I get a loan?" You will present. You will say, "Thank you for your time. I've prepared a brief overview of a mortgage opportunity one believe is a perfect fit for your institution's mission." You will walk them through the executive summary. You will be calm, confident, and organized. You will have transformed yourself from a nervous borrower into a deal maker. You are presenting them with a slam dunk, low-risk, community-building loan that will make them look good. By controlling the frame, preparing relentlessly, and presenting professionally, you make the yes the easiest, most logical conclusion they can possibly reach. You've taken away all the reasons to say no. But what happens when they take that binder and it goes behind the curtain into the mysterious world of the underwriter? That's where even the most perfect applications can fall apart due to tiny hidden tripwires. And navigating that minefield is exactly what we're covering next. The first thing you have to understand about this minefield is that the person on the other side of the desk, the underwriter, isn't your enemy. They're not trying to ruin your dream of homeownership. Their job has one single solitary purpose: to protect the lender's money. They are the final guardian at the gate. They don't know you, they don't care about the charming front porch on the house you love, and they have zero emotional investment in your story. They are financial detectives, and your application is their case file. Their entire job is to find a reason to say no. Now, here is the single most important counterintuitive secret about getting a small mortgage. You'd think a $60,000 loan would be easier to get than a $600,000 loan, right? It's less risk for the bank. But in the underwriter's world, it's the exact opposite. Your $60,000 loan application is often scrutinized more harshly than the big ones. Why? Because of simple economics. It takes an underwriter, an appraiser, a processor, and a title company just as much time, effort, and paperwork to approve your small loan as it does for a loan 10 times its size. But the profit for the bank on your loan is minuscule. It's a tiny fraction of what they'd make on a jumbo mortgage. This means your application has to be flawless. Perfect. A tiny crack in $1 million loan application might be overlooked because the potential profit is huge. But a tiny crack in your $60,000 application? That's all the excuse the underwriter needs to stamp it denied and move on to the next file that will actually make the bank some real money. The profit margin is so thin, it's just not worth their time to solve any problems. Your file is guilty until proven innocent. So, how do they put your application on trial? They judge it based on 3 core pillars, what the industry calls the 3 C's: credit, capacity, and collateral. But they look at them through a very specific, unforgiving lens. Let's start with credit. You might think, I have a 720 credit score, I'm golden. Not so fast. The underwriter sees your score, but that's just the book cover. They are about to read every single word inside. They will pull a document called a Tri-Merge Credit Report, which combines data from all 3 bureaus, Equifax, Experian, and TransUnion. They see everything. That Best Buy card you opened 2 years ago to get a discount on a TV and then forgot about? They see it. The 3 credit card applications you filled out last month because you were shopping for the best rewards program? They see that as a flurry of recent inquiries, a potential sign of financial distress. They're looking for a story of stability. A few seasoned, long-term accounts with a perfect payment history is infinitely better than a dozen new accounts with low balances. They'll scrutinize your credit utilization. If you have a $10,000 limit on a credit card and a $9,000 balance, that is a massive red flag, even if you've never missed a payment. It tells the underwriter you're living at the edge of your means. For a small loan applicant, they want to see squeaky clean. No late payments in the last 24 months, no collections, no judgments. They might even ask for a letter of explanation, or LOX as it's called, for a single 30-day late car payment from 3 years ago. You will literally have to write a letter explaining why you were late, what happened, and why it will never happen again. Feels invasive, but to them it's just a checkbox on a form. Next, and arguably the most important, is capacity. This isn't about how much money you have in the bank. It's about your proven ability to earn money and manage your debts. Can you handle this new mortgage payment? The primary tool they use is your debt-to-income ratio, or DTI. They add up all your monthly debt payments, car loan, student loans, credit card minimum payments, plus your proposed new mortgage payment, including taxes and insurance, and they divide that by your gross monthly income. Most lenders want to see that number below 43%. But here's where it gets tricky. They have to verify every penny of that income. If you're a salaried employee with a W-2, it's relatively straightforward. They'll want your last 2 years of tax returns, your last 2 years of W-2s, and your most recent 30 days of pay stubs. But what if you're a freelancer, a gig worker, or a waitress who makes most of her money in cash tips? Your application just went from a walk in the park to a climb up Mount Everest. They'll want to see a 2-year history of that income, documented on your tax returns. They'll average it out, and if your income in the most recent year was lower than the year before, guess what? They're using the lower number. They always default to the most conservative, lowest risk interpretation of the data. They will also comb through your bank statements for the last 2 to 3 months, line by line. They're looking for consistency. Do your paychecks match your pay stubs? Are there any large, unusual deposits? This is a huge tripwire. If you sold your car for $3,000 cash and deposited it, you're going to have to prove it. You'll need a bill of sale, a copy of the check, a copy of the title transfer. You have to source that deposit. A $50 check from your grandma for your birthday? Probably fine. A $5,000 gift from your parents for the down payment? They will need a formal gift letter signed by your parents, stating the money is a gift and not a loan. And they will want to see your parents' bank statement to prove they had the money to give you. It's an incredibly invasive process. They are looking for any sign of an undocumented loan or unstable income. Finally, we have the third C, collateral. The collateral is the house itself. The underwriter has one question. If you stop paying, can we sell this house quickly and get our $60,000 back? This is where the appraisal becomes the star of the show. The lender will order an independent appraisal. And this is another area where small-dollar homes face unique challenges. An appraiser will compare your potential home to other similar homes that have recently sold in the area. These are called comps. But for a $60,000 house, especially in a rural or unique area, finding good comps can be tough. There might not be many recent sales to compare it to. This uncertainty makes underwriters nervous. The appraiser is also looking at the condition of the property. For a more expensive home, a leaky faucet or some peeling paint is no big deal. For a $60,000 home, the underwriter sees it as a sign of deferred maintenance and potential money pits. Is the roof old? Is the electrical panel outdated? Is there evidence of foundation issues? An appraiser will note all of these things. An underwriter in a faraway office building will read that report and see nothing but risk. They might require a roof certification, a foundation inspection, or a plumbing inspection before they even consider moving forward. These are all costs you, the buyer, have to pay for with no guarantee of final approval. Furthermore, they hate anything unique. A tiny home on wheels, a dome home, a log cabin in a market with no other log cabin sales. These are collateral nightmares. They have no idea how to value it or how easy it would be to sell in a foreclosure. They want a boring, standard 3-bedroom, 2-bath ranch house in a subdivision with 100 other identical houses. That's predictable. That's safe. Your charming, quirky, affordable little dream home is, to an underwriter, a high-risk gamble. So after the underwriter has dissected your credit, verified every dollar of your income, and scrutinized the property appraisal, you might get what's called a conditional approval. This is the most misleading phrase in all of real estate. It does not mean you're approved. It means, we will approve you if you can satisfy this long list of demands. This is when you get the email with 10 bullet points asking for letters of explanation, proof of funds, new inspections, and updated bank statements. Each document you provide will be scrutinized, and it might even generate more questions, more conditions. This is the final grueling gauntlet, and surviving it requires patience, organization, and an almost fanatical attention to detail, because one wrong move, one document you can't produce, can send the entire deal collapsing like a house of cards. This is where the real war is won or lost. Not in the pre-approval, not in the house hunting, but in the silent, fluorescent-lit office of a single person, the underwriter. The underwriter is the final gatekeeper. They are a financial detective, a risk analyst, and a professional skeptic all rolled into one. Their job is not to help you get the loan. Their job is to protect the lender's money by finding every conceivable reason to deny you the loan. They are looking for the one loose thread that, when pulled, unravels your entire financial story. And for a $60,000 mortgage, their magnifying glass is set to maximum power. Think about it from their perspective. The bank is about to hand over $60,000 based on a stack of paper you gave them. The underwriter is the person who has to sign off and say, yes, I've personally verified everything. This person is a safe bet. This property is a safe bet. They are putting their professional judgment, and in some ways their career, on the line for a loan that will generate a laughably small profit for the bank. The amount of work they have to do, the legal compliance, the risk assessment, the documentation review, is identical to the work they do for a $600,000 loan. Same work, same risk, 1/10 the reward. This is why they have zero tolerance for ambiguity, zero tolerance for risk. Every single number on your application must be proven, sourced, and validated beyond a shadow of a doubt. So what are they looking for? They operate on a framework often called the 3 C's of credit, but they go deeper than you can possibly imagine. First, let's talk about capacity, your ability to actually repay the loan. You already gave your loan officer your pay stubs. That's not good enough for the underwriter. They will want to see, at minimum, your last 2 years of W-2s and tax returns. They want to see your last 30 days of pay stubs. And then, they're likely going to send a form directly to your employer's HR department called a verification of employment. They will ask your employer to confirm your start date, your title, your salary, and most importantly, your likelihood of continued employment. A vague answer from HR can sink your loan. They are building a timeline of your stability. Did you switch jobs 3 times in the last 2 years? That's a giant red flag. Even if you got a raise with each move, it shows instability. Are you a freelancer or an independent contractor? Prepare for an absolute nightmare. They will want to see 2 full years of tax returns showing consistent or increasing income, and they will average that income out. Had 1 great year and 1 mediocre year? They'll average it, and your qualifying income will plummet. They will scrutinize your business bank statements, wanting to know why your income dipped in July, or why you had a large expense in October. Every fluctuation is a risk they have to explain and mitigate. Then comes the most critical calculation, your debt-to-income ratio, or DTI. This is the underwriter's Bible. They will take all of your monthly debt payments, your car loan, your student loans, the minimum payments on all your credit cards, any personal loans, and add them together. Then they'll add your proposed new housing payment, which isn't just the mortgage principal and interest. It's also property taxes, homeowner's insurance, and if applicable, HOA fees or private mortgage insurance. They take that total number and divide it by your gross monthly income, your income before taxes. Let's say you make $4,000 a month. Your car payment is $300, student loans are $200, and your credit cards add up to $100 in minimum payments. That's $600 in debt. Now, let's add the proposed payment for your $60,000 house. With taxes and insurance, let's call it $500 a month. Your new total monthly debt is $1,100. Divide that by your $4,000 income, and your DTI is 27.5%. That's fantastic. But what if you have a $500 car payment, or a large credit card balance? Suddenly that number creeps up. Most lenders have a hard stop at 43% DTI. Some might go to 50% on certain government-backed loans, but for a small non-standard mortgage, they want that number as low as humanly possible. The underwriter will go through your credit report with a fine-tooth comb. And if they find a debt you didn't disclose, even a small one, it not only hurts your DTI, it damages your credibility. Next, the underwriter dissects your credit, your history and willingness to pay your debts. They have your full credit report, not the simple score you see on free websites. They see everything. That 130-day late payment on a credit card from 2 years ago? They'll see it. That medical bill that went to collections that you thought was resolved? They'll see it. And for every single derogatory mark, they will require a letter of explanation, or LOX. This is a formal letter signed and dated, where you explain exactly what happened. This isn't a place for excuses. It's a place for facts. I was laid off in March of 2021, which resulted in a 60-day late payment to my auto loan. I secured new employment in June of 2021 and have made all payments on time since, as you can see from my record. You have to own it, explain it, and show it was a temporary situation, not a character flaw. For a small loan, an underwriter might ask for a LOX for things that would be ignored on a larger loan, simply because they are building a case either for you or against you, and they need every piece of evidence they can get. Finally, and most critically for low-priced homes, the underwriter scrutinizes the collateral, the house itself. The bank is not lending you money out of the goodness of their heart. They are investing in an asset. They need to be absolutely certain that if you stop paying, they can sell the house and get their $60,000 back. This is where the appraisal comes in. The lender will hire an independent appraiser to inspect the home and determine its fair market value. The appraiser will look at the condition of the home, its size, its features, and most importantly, what similar homes in the immediate area have recently sold for. This is a massive hurdle for $60,000 homes. If the house is in a rural area with few recent sales, the appraiser may struggle to justify the value. If the house needs significant repairs, a leaky roof, old wiring, foundation issues, the appraiser might flag it as not meeting minimum property standards, making it ineligible for a traditional mortgage. And if the appraisal comes in low, say at $50,000, the deal is in serious trouble. The bank will only lend based on the appraised value. You would either have to come up with the extra $10,000 in cash, or the seller would have to lower the price. Often the deal just dies right there. Alongside the appraisal, the underwriter will order a title search. A title company scours public records to make sure the person selling you the house actually has the legal right to sell it, and that there are no hidden claims or liens on the property from old contractors, ex-spouses, or the IRS. This is non-negotiable. The title must be clear for the loan to be approved. After weeks of this intense scrutiny, you don't just get a clear yes or no. You get what's called a conditional approval. This is the underwriter's list of demands. It's a list of things you must provide before they'll give the final sign-off, the coveted clear to close. And this is where things can get personal and frankly absurd. They'll go through your bank statements line by line. That $500 your mom transferred you for your birthday? They'll demand a signed gift letter from her stating the money is a gift, not a loan that needs to be repaid, and they'll want to see the money leaving her bank account to prove it. That $100 Venmo deposit from a friend who is paying you back for concert tickets? You'll have to write a letter explaining it. They will question every large deposit and every unusual withdrawal. They are making sure you aren't secretly borrowing money for a down payment, which would throw off your DTI ratio. This is the final trial by fire. You're digging through old files for divorce decrees, scanning pay stubs from jobs you left years ago, calling relatives to sign legal documents. Feels invasive. Feels personal. It feels like you're being treated like a criminal. And you have to do it all with a smile, responding to every request immediately. Because any delay on your part can push back your closing date and jeopardize the entire purchase. You've survived the underwriter's interrogation. You've jumped through every hoop, explained every penny, and documented every moment of your financial life for the past 2 years. You're exhausted, but you see the finish line. Then the phone rings. It's your loan officer. And the first words you hear are, "We have a problem." A problem that has nothing to do with your finances, but with the house itself. The problem isn't your credit score. It's not your debt-to-income ratio, your down payment, or your job history. You passed all of those tests with flying colors. The problem, the loan officer explains, is the appraisal. The appraisal came in low. And it came in with conditions. Your stomach turns into a knot of ice. You've heard these terms before, but they were abstract concepts, things that happened to other people in stories online. Now they are the twin wrecking balls aimed directly at your dream. Let's break this down because this single event, the appraisal, is the #1 killer of small mortgage deals in America. It's a silent executioner that most first-time buyers never see coming. Every lender requires an appraisal before they give you a mortgage. Why? Because the house isn't just your future home. It's the bank's collateral. It's their insurance policy. If you stop making payments, the bank has to take the house and sell it to get their money back. So, they need to know 2 fundamental things. First, what is this house actually worth right now on the open market? And second, is this house in a condition that makes it a safe and stable investment? Your loan officer starts with the first problem, the value. You agreed to pay the seller $65,000. Felt fair. It was in your budget. But the appraiser, an independent third party, scoured the neighborhood for recent, comparable sales, the comps. They looked at other small homes similar in size and condition that have sold in the last few months. And after their analysis, they determined the house is only worth $58,000. This is called an appraisal gap, a $7,000 gap. And the bank, your lender, will only ever lend you a percentage of the appraised value, not the purchase price. They see a $58,000 asset, so they will base their loan on that number, period. Suddenly, you don't need to cover just your down payment and closing costs. You need to magically produce an extra $7,000 in cash to bridge the gap between what the seller wants and what the bank is willing to finance. For someone stretching every penny to afford a $60,000 home, an extra $7,000 might as well be $7 million. It's a deal breaker. What are your options? You can go back to the seller, hat in hand, and ask them to lower the price to the appraised value of $58,000. In a slow market, they might agree. But in most places today, the seller will just laugh and say, "Fine, I'll put it back on the market." The next buyer might be paying cash and won't even need an appraisal. You can try to challenge the appraisal, but that's an uphill, often fruitless battle. Or you can walk away, losing the money you already spent on the inspection and appraisal, and start your crushing, soul-destroying search all over again. Your heart sinks. But then the loan officer says, and that's not even the biggest issue. The biggest issue, he explains, is the second part of the appraiser's report, the property condition. The appraiser isn't just a number cruncher. They're the bank's eyes and ears. They walk through the property looking for problems that could jeopardize the bank's investment. They are looking for things that violate the lender's minimum property standards. These are basic health and safety requirements. The house must be safe, sound, and sanitary. And on this $65,000 house, The appraiser found a laundry list of violations. There's peeling paint on the exterior window trim. Because the house was built before 1978, that's a potential lead paint hazard. Fail. The back steps don't have a handrail. That's a safety hazard. Fail. There's a water stain on the ceiling in the bedroom, indicating a potential roof leak. That's a soundness hazard. Fail. One of the bedroom windows is painted shut and doesn't open. That's a fire safety violation. Fail. The appraiser's report comes back marked subject to repair. This is the death knell. It means the bank will not, under any circumstances, fund your loan until every single one of those items is fixed. The peeling paint must be scraped and repainted by a professional. A handrail must be installed. A roofer needs to certify the roof is sound. The window must be made operational. All of it has to be done before closing. And right there, you are slammed into the great unmovable wall of the low-cost housing market. A catch-22 from which there is often no escape. Think about it. The seller is selling the house, as is precisely because they don't have the money or the desire to make these repairs. They just want to sell and move on. So they refuse to fix anything. But you, the buyer, can't possibly pay for repairs on a house you don't even own yet. What if you spend $5,000 fixing the roof and installing a handrail, and then the seller backs out of the deal for some other reason? You're out $5,000 with nothing to show for it. It's an insane risk. So the seller won't pay for the repairs. You can't pay for the repairs. And the bank absolutely will not give you the loan to buy the house until the repairs are complete. The deal is dead. You are completely and utterly stuck. This is the hidden tragedy of the affordable housing market. This is the reason why so many homes under $100,000 are snapped up by all-cash investors. An investor doesn't need a bank. They don't need an appraisal. They don't care about minimum property standards. They can buy the house with its peeling paint and leaky roof, slap on a few cosmetic fixes, and then either rent it out for a massive return or flip it for $120,000, pushing the price of homeownership even further out of reach for people like you. They exploit this exact catch-22 that traps regular, hardworking buyers. Your dream, which was so close you could almost taste the paint fumes of a new beginning, is evaporating. You did everything right. You saved your money, you built your credit, you found a house you could genuinely afford. But you were failed by the very system designed to enable homeownership. You were blocked by a set of rules that make perfect sense for a $400,000 suburban house, but that act as an impossible barrier for the exact kind of starter homes this country desperately needs. You hang up the phone, the silence of your tiny apartment suddenly feeling heavier, more permanent. The finish line you saw just an hour ago has vanished over the horizon. Feels like the end of the road. But what if it wasn't? What if there was a secret trap door in this catch-22? A different kind of loan designed specifically for this exact heartbreaking situation? A loan that doesn't just see a house with problems, but sees its potential? A loan that would not only let you buy the house, but would also give you the money you need to fix the peeling paint, to repair the roof, to build that handrail, and to turn that unlendable property into a safe and beautiful home. A loan that rolls the purchase price and the cost of repairs into one single affordable mortgage. This incredible tool is called the FHA 203K Rehabilitation Mortgage. And it is, without a doubt, one of the most powerful and misunderstood secrets in the world of affordable homeownership. Think of it as a financial Swiss Army knife. It's not just a key to a door. It's the key, the hammer, the screwdriver, and the paintbrush all rolled into one. It allows you to look at a house that every other buyer runs away from, the one with the scary, outdated kitchen, the questionable plumbing, the roof that's seen better days, and see it not for what it is but for what it could be. The 203K loan program essentially says, we see the potential too. We'll give you the money to buy the house and the money to fix it up, all in a single loan, with a single monthly payment. This is a complete game changer. Suddenly, that huge pool of unlendable properties, the houses that banks won't touch with a 10-foot pole, becomes your own private hunting ground. Now, there are two main flavors of this loan, and it's crucial to know the difference. The first is the Limited 203K, often called the Streamline 203K. This is your go-to for cosmetic and non-structural repairs. Think of it as the home makeover loan. It's for homes that are fundamentally solid, but need a serious facelift. We're talking about replacing the shag carpet with beautiful new flooring, gutting that avocado green bathroom, installing a brand new kitchen with granite countertops and stainless steel appliances, replacing all the windows, or even getting a new furnace or air conditioner. The Streamline 203K typically has a cap on the amount you can finance for repairs, usually around $35,000, and the process is, as the name implies, more streamlined and less complex. But what if the house needs more than just a makeover? What if it needs major surgery? That's where the second flavor comes in. The standard 203K. This is the heavy hitter. This is the loan that lets you take on the big, scary projects that make for dramatic before and after photos. Do you need to move a wall to create an open-concept living space? The standard 203K can cover that. Do you need to repair a cracked foundation or address serious termite damage? Can cover that. Do you want to add an entire new bedroom or a second story to the house? Yes, it can even cover that. Because the standard 203K involves structural changes, the process is more involved. It requires you to work with a HUD-approved consultant who acts as your project manager, inspecting the property, preparing a detailed work plan, and overseeing the construction to ensure everything is done correctly and on budget. It's more work, yes, but it allows you to literally rebuild a house from the inside out and turn a dilapidated structure into your dream home. So how does this actually help you get a $60,000 mortgage? Let's make this real. Let's talk about a homebuyer. We'll call her Maria. Maria lives in a mid-sized town in the Midwest. She's got a steady job, decent credit, and has saved up a small down payment. She's tired of paying rent. She's pre-approved for a mortgage up to about $90,000, but everything she sees in that price range is either in a bad neighborhood or a tiny condo with sky-high HOA fees that eat up her budget. She's starting to feel hopeless. Then her agent, who's smart and knows about these programs, shows her a house listed for just $50,000. It's a small 2-bedroom bungalow in a quiet, established neighborhood with good schools. The location is perfect. But the house is a time capsule from 1968. The roof is nearing the end of its life. The wiring is ancient. The kitchen is tiny and dark, and the furnace sounds like a jet engine taking off. No conventional lender will finance it in its current condition. It's a cash-only investor special kind of deal. Maria's heart sinks. It's another dead end. But her agent says, wait, let's look at this with a 203K lens. They bring in a contractor to walk through the property. The contractor puts together a detailed bid. A new roof, $8,000. Upgrading the electrical panel and wiring, $5,000. A complete kitchen gut and remodel, $12,000. A new high-efficiency furnace and AC unit, $7,000. Total repairs, $32,000. Here's where the magic happens. Under the FHA 203K program, Maria's loan isn't based on the current, rundown value of $50,000. The loan is based on the future value, or the as-completed value, of the home after all the work is done. So the math looks like this. Purchase price, $50,000. Cost of repairs, $32,000. Total base amount, $82,000. The lender will also roll in a contingency reserve, usually 10 to 20% of the repair cost, just in case of unexpected issues. Let's say that's another $4,000. So the total loan amount Maria is applying for is around $86,000. The bank orders an appraisal, but it's a special kind of appraisal. The appraiser determines two values, the as-is value, which is $50,000, and the as-completed value, based on the contractor's detailed plans. The appraiser looks at other recently renovated homes in the neighborhood and determines that once Maria's house has a new roof, new kitchen, and new electrical, it will be worth $105,000. Suddenly, the bank is ecstatic to give Maria an $86,000 loan on a house that will be worth $105,000. It's a secure, low-risk investment for them. At closing, the seller gets their $50,000. The remaining $36,000, the repair money plus the contingency fund, is placed into a special escrow account. As the contractor completes each phase of the work, first the roof, then the electrical, then the kitchen, the HUD consultant or an inspector verifies the work, and the lender releases a payment or a draw from the escrow account to the contractor. 6 weeks later, Maria moves in. She doesn't move into a $50,000 fixer-upper. She moves into a completely renovated, updated, safe, and beautiful home that she helped design. And the best part? She walks in the door with nearly $20,000 in instant equity. Her mortgage is for $86,000, but her home is already worth $105,000. She didn't just buy a house. She made a brilliant financial investment. She bypassed the competition and created value where no one else saw it. Of course, this path isn't for everyone. It requires patience. A 203K loan takes longer to close than a standard mortgage, often 60 to 90 days. It requires a team, a lender, a real estate agent, and a contractor who are all experienced with the 203K process. Trying to do this with people who don't know the rules is a recipe for disaster, and it requires a vision. You have to be willing to live through a bit of dust and decision-making. You can't just turn a key and move in the next day. But for the right person, the FHA 203K is more than just a loan. It's an opportunity. It's a pathway to homeownership that lets you build wealth from day one, in a home that you've customized to your exact tastes. It's how you can take a $50,000 or $60,000 unlendable house and transform it into a $100,000 asset, using the bank's money to do it. This is one of the federal government's most powerful programs for revitalizing communities and helping regular people get ahead. But it's primarily focused on properties that need work. What if you're not looking for a project? What if you find a perfectly good, move-in ready house for $60,000, but it's just not in a big city? What if your dream is to escape the urban sprawl and buy a small home in a rural community? Well, it turns out the government has a loan for that too. An incredible loan, in fact, that for some people requires no down payment at all. It's called the USDA Rural Development Loan. And before you click away thinking, I don't want to buy a farm, hold on. This is one of the most misunderstood and powerful loan programs in the entire country, and the definition of rural is probably a lot bigger than you think. This program is backed by the United States Department of Agriculture. Its goal is simple: to encourage development and homeownership in non-urban areas. To do this, they've created a loan so attractive it almost sounds fake. The headline feature, the one that changes everything for so many people, is the zero down payment requirement. 100% financing. You can get into a home without putting a single dollar down. How is this possible? It's not magic, it's a guarantee. The USDA doesn't actually lend you the money. A private lender like a bank or a credit union does, but the USDA provides that lender with a government guarantee, promising to cover a significant portion of the loss if you default on the loan. For the lender, this wipes out almost all of their risk. And when a lender has no risk, they don't need you to have skin in the game with a big down payment. It's the government's way of saying, hey, we trust this borrower in this area, so you should too. This government backing has other incredible benefits. Because their risk is so low, lenders can offer incredibly competitive, often below market interest rates on USDA loans. And the credit score requirements? They're flexible. While a 640 score is often the benchmark to get streamlined approval, it's not a hard and fast rule. Lenders can and do approve borrowers with lower scores if they have other compensating factors, like a steady job history or a low debt-to-income ratio. So you're thinking, okay, zero down payment, low interest rates, flexible credit. What's the catch? And you're right to ask. There are two major requirements you have to meet, and they are non-negotiable. First, the property location. The home you want to buy must be in a USDA-eligible area. This is the biggest hurdle. But here's the secret. The USDA's definition of rural is incredibly broad. It doesn't just mean cornfields and dirt roads. It includes thousands of small towns, suburbs, and communities on the outskirts of major metropolitan areas. We're talking about places with populations under 35,000. You would be absolutely shocked to find out how much of the United States map qualifies. There are eligible towns just a 30 or 40-minute drive from major cities like Atlanta, Dallas, or Chicago. The USDA has an official eligibility map on their website. You can literally type in an address, and in 2 seconds, it will tell you if the property qualifies. It's a tool that could completely change your home search. The second major requirement is income. This program is designed for low to moderate income households. This means your total household income cannot be more than 115% of the median income for that specific area. Again, don't write yourself off. Moderate income can be a lot higher than you think, especially in counties with a higher cost of living. For a family of 4, the income limit in many areas can be over $100,000 a year. Just like the property map, the USDA has an income eligibility calculator online where you can input your state, county, and household size to see the exact limit for your area. So let's bring this back to our $60,000 mortgage. You find a perfect little house in a charming small town that qualifies on the USDA map. You check the income limits and you're well within the range. You're ready to go. How does the USDA loan structure this? While there's no down payment, There are two costs associated with the program that you need to know about. Think of them as the price you pay for the incredible benefit of 100% financing. First is an upfront guarantee fee. As of now, it's 1% of the loan amount. So for your $60,000 loan, that's a $600 fee. But here's the key part. You almost never pay this out of pocket. This fee is rolled right into your total loan amount. So you're actually borrowing $60,600. Your loan is slightly bigger, but you still walk into closing with zero cash down. Second is an annual guarantee fee, which functions a lot like PMI. This fee is paid monthly as part of your mortgage payment. Right now, it's 0.35% of the remaining loan balance each year. Let's do the math on your $60,000 loan. 0.35% of $60,000 is $210 for the entire year. Divide that by 12 months and you get just $17.50 per month. $17.50. That is an incredibly low cost. For comparison, the mortgage insurance on an FHA loan for the same amount would be significantly higher, often more than double that. So let's picture the whole thing. You find a $60,000 home. You get a USDA loan. You finance the $600 guarantee fee, bringing your loan to $60,600. Let's say you get an interest rate of 6.5%. Your principal and interest payment would be about $383 a month. Add in an estimate for property taxes and homeowners insurance, let's say $150. Then add your $17.50 USDA fee. You're looking at a total monthly payment of around $550. For many people, that is dramatically less than what they're currently paying in rent for an apartment. This is the power of the USDA loan. It's a pathway to homeownership for people who are great, responsible candidates but simply haven't been able to save up the traditional 5, 10, or 20% down payment. It's for the family that wants a backyard for their kids, the young couple looking to escape sky-high city rents, or the individual who dreams of a quieter life in a community where they know their neighbors. Of course, a few other rules apply. The home must be your primary residence. No investment properties or vacation homes. And the house itself has to meet certain minimum standards for safety and livability, which is verified during the appraisal process. But frankly, that's a protection for you, ensuring you're not buying a money pit. The USDA loan isn't for everyone or for every location. But for the right person and the right property, it is an absolute game changer. It transforms the dream of owning a home from a distant 10-year savings goal into a tangible, achievable plan you can start this year. It opens up huge swaths of the country where affordable housing still exists, and it provides the financial tool to access it without a massive pile of cash. So we have FHA for low down payments, conventional for the well-prepared, and USDA for rural dreams. But what if you're a veteran? What if you've served this country? There's a program that is arguably the most powerful home loan in existence, one that can also get you into a home with zero down, but with even fewer restrictions. It's a benefit you've earned. I'm talking about the VA loan, a program backed by the U.S. Department of Veterans Affairs. And let's be clear about what that means. The VA itself doesn't lend you the money. Instead, it provides a guarantee to the lender. It's like the federal government co-signing your loan. They're telling the bank, hey, this veteran is a good bet. But if for some reason they can't pay, we've got your back. This single fact completely changes the game for lenders, and in turn, it unlocks a set of benefits so powerful they almost sound made up. First and most famously, zero down payment, 100% financing. This isn't a special exception or a program you have to hunt for. It is the standard for a VA loan. For our $60,000 house, that means you don't need to scrape together 3, 5, or 10%. You can potentially walk into that home without putting a single dollar down on the purchase price. This is the single biggest barrier to homeownership for most people, and the VA loan simply erases it. Second, and this is a massive financial advantage, no monthly mortgage insurance. Remember that private mortgage insurance, or PMI, from conventional loans? Or the mortgage insurance premium, MIP, from FHA loans? That extra $100 or so you pay each month that does nothing to build your equity. With a VA loan, it's gone. It doesn't exist. On a $60,000 FHA loan, you could be paying that insurance for the entire life of the loan. With a conventional loan, you'd pay it for years until you hit 20% equity. With a VA loan, that money, hundreds of dollars a year, thousands over the life of the loan, stays right in your pocket from day one. Third, because the loan is guaranteed by the government, lenders view it as extremely low risk. And what happens when risk goes down? interest rates go down. Veterans often receive some of the most competitive interest rates on the market, saving them even more money over the 30-year term. And fourth, the VA doesn't impose a maximum loan limit for veterans who have their full entitlement. Now, for a $60,000 loan, this is obviously not a concern, but it speaks to the immense trust and power of the program. The VA is essentially saying, "We trust you to buy a home you can afford, and we will back you." So what's the catch? There has to be a catch, right? Well, sort of. It's called the VA funding fee. This is a one-time fee paid directly to the Department of Veterans Affairs, and it's what keeps the entire program running for future generations of veterans without costing the taxpayer. The fee is a percentage of the loan amount, and it varies. For most first-time users putting zero down, it's 2.3%. On a $60,000 loan, that's about $1,380. But here's the key. You almost never have to pay this out of pocket. In most cases, the funding fee can be rolled right into your total mortgage amount. So your loan becomes $61,380, and you still close on the house with zero down. And here's an even bigger deal. Some veterans are completely exempt from the funding fee. This includes veterans receiving VA disability compensation and certain surviving spouses. For them, the program is truly zero down and zero mortgage insurance. So, who is eligible for this incredible benefit? It's for active duty service members who have served for a specific period, typically 90 continuous days. It's for veterans who meet minimum service requirements, which depend on when they served. It's for members of the National Guard and Reserves who have 6 years of honorable service. And it's for certain surviving spouses of service members who died in the line of duty or from a service-related disability. The first step is always to obtain your Certificate of Eligibility, or COE, which is the official document that proves to the lender you qualify for the benefit. A good lender who specializes in VA loans can help you get this in minutes. Now, let's bring it all back to the $60,000 question. Why is the VA loan the ultimate cheat code for getting a small mortgage? Because the VA has no minimum loan amount. Let me say that again. The U.S. Department of Veterans Affairs does not set a floor on how small a loan can be. This directly attacks the core problem we've been discussing: a lender's reluctance to originate small loans. Think about it from the bank's perspective. A $60,000 conventional loan is a small return with a non-zero risk of default. But a $60,000 VA loan? That loan is backed by the full faith and credit of the United States government. The risk of the bank losing money plummets to virtually zero. Suddenly, that small loan looks a lot more attractive. It's a safe, stable asset for their portfolio. This is why you will find lenders far more willing to process a small VA loan than any other loan type. They are incentivized by safety. Of course, the property itself still has to qualify. The VA wants to protect veterans from buying homes that are unsafe or in terrible condition. They have a set of standards called Minimum Property Requirements, or MPRs. The home must be safe, structurally sound, and sanitary. The appraisal process for a VA loan is more thorough than for a conventional loan. The appraiser will check to make sure the roof is in good shape, the electrical systems are safe, there's no peeling paint if the house is old enough to have lead paint, and that the heating and plumbing work properly. For a $60,000 house, which might be older or in need of some TLC, this can sometimes be a hurdle. But think of it not as a barrier but as a protection. The VA is looking out for you. They are preventing you from using your hard-earned benefit on a money pit. And many of these required repairs can be paid for by the seller as part of the negotiation process. So for a qualified veteran, the path becomes crystal clear. You find a lender who is a true VA loan specialist. Not just a bank that does them on the side, but an expert who lives and breathes this program. They will understand the nuances and champion your application. No matter how small the loan, they help you get your Certificate of Eligibility. You get pre-approved. You find that $60,000 home and you make an offer. The VA appraisal ensures the home is a good investment, and you can potentially move into that home with little to no money out of your own pocket, enjoying a low interest rate and no monthly mortgage insurance. You used a benefit you earned through your service to achieve the American dream, even when other paths seemed blocked. But what if you're not a veteran? What if the FHA and conventional loan options we discussed just aren't working in your specific market, for your specific $60,000 house? Is it game over? Do you just give up and keep renting? Not even close. There is an entire world of financing that exists outside of these big, government-backed programs. A world of local solutions, creative strategies, and options that most people never even hear about from a big national lender. We're talking about the unique power of small community banks, mission-driven credit unions, and the almost forgotten art of seller financing. In our final part, we are pulling back the curtain on the secret weapons that get these deals done when all else fails. And these secret weapons, they all hinge on one fundamental shift in thinking. You have to stop trying to fit your small loan into the big bank's box. Instead, you need to find the lender whose box is already the right size. The first and most powerful of these is the portfolio loan. This might be the most important term you learn in your entire home buying journey. A portfolio loan. What is it? When a big national bank gives you a mortgage, they almost immediately bundle it up with thousands of other mortgages and sell it on the secondary market to giant entities like Fannie Mae or Freddie Mac. They just service the loan, they don't actually own it anymore. And because they plan to sell it, the loan has to meet the incredibly rigid, one-size-fits-all criteria that Fannie and Freddie demand. If your loan is for only $60,000, it's like a faulty product on their assembly line. Gets rejected. But a portfolio lender is different. They are typically a local community bank or a credit union that intends to keep your loan in-house, on their own books, in their own portfolio. They are not selling it. And that one fact changes everything. Because they aren't selling it, they don't have to follow Fannie and Freddie's rules. They get to make their own. Think of it like this: the big banks are like a giant automated factory. They only accept perfectly uniform, standard-sized parts. If your loan is too small, or the property is a little quirky, it's a custom part they simply cannot process. The machine spits it out. A portfolio lender, on the other hand, is like a master craftsman in a local workshop. They can pick up your unique situation, your custom part, and they can look at it from all angles. They can use common sense. They can make a judgment call. The craftsman can say, "Yeah, this is unusual, but I see the value here. I can make this work." When you're talking to a portfolio lender, you're often not just talking to a loan officer plugging numbers into a computer. You're talking to someone who might be one step away from the actual underwriter or the loan committee, the real human beings making the decision. They can look at your $60,000 loan and see it not as a waste of their time, but as a low-risk investment in their own community. They understand the local market. They know that a small two-bedroom house in a certain neighborhood is a rock-solid asset. So how do you find these magical lenders? You pick up the phone. You call every small local bank and credit union within a 50-mile radius. And you don't ask, "Do you do mortgages?" Of course they do. You ask the magic words. "Do you offer portfolio loans?" Or, "Do you keep your mortgages in-house?" When you hear a yes on the other end of that line, you've found a potential partner. You've found the craftsman's workshop. But what if even the portfolio lenders say no? What if the property is in rough shape? Or your financial situation is just too unconventional? This is when you bring out the next secret weapon: private money and hard money lenders. Now I know what you're thinking. The term hard money sounds intimidating. It sounds like something out of a gangster movie. But let's pull back the curtain. A hard money lender is simply a private individual or a company that lends their own money for real estate deals. They are not a bank. They are investors. And because they're investors, they think differently. A traditional bank is obsessed with you, the borrower, your credit score, your debt-to-income ratio, your job history. A hard money lender, on the other hand, is obsessed with the asset, the property itself. Their primary question isn't, "Can you afford to pay us back?" It's, "Is this a good deal?" If you're buying a house that's clearly worth $100,000 for just $60,000, their eyes light up. They see the built-in equity. Their risk is protected by the property itself. If you default, they don't really lose because they can take the property and sell it for a profit. This asset-based approach makes them incredibly flexible. They don't care if the loan is small. They don't care if the house needs a new roof or has a cracked foundation, as long as the numbers make sense after the repair. But this flexibility comes with a trade-off, and it's a big one. The terms are not friendly for the long haul. You're looking at much higher interest rates, sometimes double or triple a conventional mortgage, and very short terms, typically just 1 to 5 years. So why would anyone do this? Because hard money is not a destination. It's a bridge. It's the tool you use to get from point A, owning a problematic property that no bank will finance, to point B, owning a stabilized, valuable asset that any bank would be thrilled to refinance. Let's paint a picture. You find a perfect little bungalow for $60,000, but it's been neglected. It needs $20,000 in work. No bank will touch it. A hard money lender sees the vision. They lend you the $60,000 to buy it. You use your own cash or a personal loan for the renovations. For 6 intense months, you fix it up. You put in a new kitchen, you paint everything, you landscape the yard. Suddenly, this neglected house is the gem of the neighborhood. You get it reappraised and it's now worth $130,000. Now, you walk back into that local community bank, the one that rejected you before. But you're not the same person asking for the same thing. You're not asking for a tiny risky loan on a beat-up house. You are now the proud owner of a valuable, stable asset, and you're simply asking to refinance it to pay off your expensive short-term bridge loan. You're asking for a $70,000 or $80,000 loan on a $130,000 property. To the bank, you are now one of the safest bets they could possibly make. The entire game has changed. You use short-term, expensive money as a strategic tool to create value and unlock long-term, affordable financing. This brings us to our final weapon, which isn't a single tool, but the art of combining all of them. Think like a deal maker. What if you find a $60,000 house and the seller is willing to do seller financing, but only for $20,000? Great. Now you only need to go to the community bank and ask for a $40,000 loan. That's a much easier conversation. What if you have some savings but not enough for the whole purchase? Maybe you take out a $25,000 unsecured personal loan from a company like SoFi or Lightstream, combine it with $25,000 in savings, and now you can make a nearly cash offer, which sellers love. The interest rate on the personal loan will be higher, but just like hard money, it's a bridge. You use it to secure the asset, then you refinance everything into a single, affordable mortgage a year later. As we stand here at the end of this journey, the truth becomes crystal clear. The problem was never that a $60,000 mortgage is impossible. The problem is that we've been trying to use a tool designed for a $400,000 suburban home, the standardized 30-year fixed-rate mortgage from a megabank, on a completely different kind of project. It's like trying to build a delicate watch with a sledgehammer. You don't need a bigger hammer. You need a different set of tools entirely. Securing a small mortgage in America today is not a simple transaction. It's a quest. It forces you to become more than just an applicant. It forces you to become a problem solver, a detective, a networker, and a creative deal structure. We've traveled from the cold, algorithmic rejection of the national lenders to the warm, common-sense handshake of a community bank. We've explored the elegant simplicity of seller financing and uncovered the hidden power of portfolio loans and private money. Buying a $60,000 home isn't just about saving money. It's about unlocking a level of financial freedom and wealth creation that most people believe is completely out of reach. It's about buying an asset that can generate income, not just a place to live that generates debt. It's a powerful rejection of the idea that the only path to homeownership is a $500,000 ball and chain that will follow you for the next 30 years. The system may be built for the big loans and the standard issue properties, but the opportunities for the smart, for the persistent, for the person willing to make one more phone call, are hiding in plain sight. You just have to know where to look and how to ask. And now you do. The question was never really, can you get a $60,000 mortgage? The real question is, are you willing to do what it takes to find one? Because it is absolutely, unequivocally possible.